You got a raise. You remember the feeling. That first paycheck with the new number on it. Relief. Finally, some breathing room. Maybe you'd treat yourself a little. You'd earned it. 3 months later, the breathing room is gone. The budget feels exactly as tight as it did before the raise arrived. Nothing dramatic happened. No emergency, no reckless spending spree. The money just went somewhere. Here is what actually happened. You paid a tax. Not the kind that shows up on a pay stub, not the kind any government collects. A tax that has no name in most people's vocabulary, no filing deadline, and no published rate. And it took a bigger cut of your raise than the IRS ever could. It's called the lifestyle tax, and almost nobody is taught to see it before it has already collected. The lifestyle tax is never collected through one decision. It's collected through a sequence of small, individually reasonable upgrades that activate automatically the moment income rises. The apartment that was fine last year suddenly feels like it's time to move somewhere nicer. The food delivery that used to be an occasional treat becomes the normal Tuesday. The streaming subscription that felt indulgent at the old salary feels practically necessary at the new one. None of these decisions feels like spending more. They feel like finally being able to afford what they deserved all along. Research on raising behavior is remarkably consistent on this point. The majority of any income increase gets absorbed into lifestyle within roughly 90 days, without a single deliberate decision being made. The brain treats new income as the new normal almost immediately. No meeting is held, no budget is revised on paper. The spending simply rises to meet the income, the same way water finds its level. This is the mechanism, not a moment of weakness, not a lapse in discipline. A default setting nobody told you that you had. Let's calculate the actual rate, because once you see the number, you won't forget it. Say you get a $500 monthly raise. If 80% of that raise gets absorbed into lifestyle upgrades, the nicer apartment, the extra delivery orders, the new subscription, you have just paid an 80% lifestyle tax. Compare that to your actual income tax bracket. The highest federal income tax bracket in the United States tops out at 37%. The lifestyle tax, for most people receiving a raise, runs somewhere between 70% and 95%, more than double the highest tax rate the government is legally allowed to charge you. Nobody protests this tax. Nobody writes to their representative about it. Nobody even notices the rate because no single transaction announces itself as the lifestyle tax. It's collected one Uber Eats order, one upgraded apartment, one new subscription at a time, each one too small to question, all of them together consuming almost the entire raise. The government takes a third. The lifestyle tax takes almost everything else. Income tax is visible by design. It has a line item on your pay stub. It has a published rate you can look up in 30 seconds. It has a filing deadline that forces an annual reckoning whether you want one or not. The lifestyle tax has none of that. There's no line item because there's no single transaction to label, just dozens of small ones spread across a month. There's no published rate because nobody is tracking it on your behalf. There's no annual filing because there's no form that exists to make you calculate it. Every individual upgrade that contributes to the lifestyle tax feels voluntary, earned, and reasonable in the moment it happens. That's exactly what makes the cumulative rate invisible. You would never agree to an 80% tax if someone presented it to you as a single number. But broken into 20 small decisions across 30 days, it sails through completely unnoticed and unquestioned. The tax isn't hidden because someone is hiding it from you. It's hidden because nobody ever taught you to add it up. 2 moves lower the lifestyle tax rate, and neither requires willpower in the moment, because by now, you already know willpower is not a reliable strategy. The first move is the 72-hour lifestyle freeze. The moment any income increase arrives, a raise, a bonus, a new job offer, freeze the lifestyle completely for 72 hours before allowing a single upgrade decision. No apartment search, no new subscription, no upgraded plan of any kind. 72 hours converts an automatic decision into a deliberate one. Most lifestyle tax collection happens in the first impulsive days after a raise lands, while the relief is still fresh and the brain is most eager to spend the feeling. The freeze interrupts that window completely. The second move is the one we've covered before, applied specifically here. Direct a fixed percentage of every raise straight into an investment account before it ever reaches your checking account. Not after you've lived on it for a month and seen what's left. Before. The same week the raise arrives. If your raise is $500 and you redirect $350 immediately, your lifestyle tax rate on that raise just dropped to 30%, lower than any federal income bracket by your own design. Neither of these moves asks you to live smaller. They simply ask you to decide on purpose what the lifestyle tax will collect, instead of letting it collect by default while you're not looking. Go back to that raise, the one that disappeared. It did not fail you. You did not waste it. The tax simply collected before you ever had the chance to notice it was being collected. The same way every tax works when nobody points it out. Now you can see it. Now it has a name. And the moment something has a name, you get a choice you never had before. Not to eliminate it, but to decide what rate you're actually willing to.